Are you ready to overcome the complexities and burdens that come with your success? Join the team at Centura Wealth Advisory in the Live Life Liberated podcast. Now, on to the show.
Hello and welcome to Live Life Liberated with the team from Centura Wealth Advisory. Hosting this podcast is Bryan Schick. And Bryan, I see you have a guest with you. Why don't you introduce your guest and then tell us what you're going to be talking about on this podcast?
Sure. Welcome to the podcast. Our guest speaker today is Dan Stolfa, a senior wealth advisor at Centura Wealth Advisory. Little quick introduction. By training and by his past experience, he's a trust and estates attorney. Has joined our team here at Centura to provide excellent service and insight to planning strategies for our clients. But Daniel, I'm going to turn it over to you for just a second. Give us a little bit a little bit about your background, please.
You covered an awful lot of it. Thank you so much for having me, Bryan. Started out as a T&E attorney about 30 years ago, and for the last 20 years, I've been in ultra high net worth wealth management. Did a little while in public for accounting, but basically the only thing I've ever done is work with folks of significant means and help them plan out their futures and make the best of what they have for their families. So glad to be here. Thanks.
That's great. Yeah, I enjoy a similar thing. A little bit about me is I've been in this services about 25 years, financial services. Grew up in mergers and acquisitions. Did some accounting as a CPA, and then most recently, in the past 10 years or so, I've been working with family offices, doing similar things, structuring, tax savings and wealth transfer and legacy planning for ultra high net worth clients. So I'm looking forward to our podcast / interview today, Daniel. So let's get into it. Today's topic is post-election exemption planning. We'll get into what that means. There's a lot of things going on in the press every day. You turn on the news or you read an article about exemption. So maybe if you'd kind of start off with, and I'm going to start with, a little bit about Centura and our clients and how our typical clients would work with the exemption that we're going to talk about today. So basically we have, three types of clients. We have founder-led businesses. With individuals with 20 million of net worth or 2 million or more of income looking for a transition or disposition in the future, or maybe holding on to their business. The second type of client we work with are public company, what we call C-suite executives, high W-2 earners, sit big four positions in publicly traded companies. And then finally, we work with other high net worth families with 25 million plus worth of net worth. So using that as a guideline today, Daniel, let's get into exemption planning post-election and give us a little idea on how's the current transfer tax system work in the United States, and tie that back to exemptions. We're using some big words out of the gates. Let's define those and set some context.
Sure, happy to. So basically what happens in the federal system, and each state is a little bit different, but we'll concentrate on the federal today and be using only the federal numbers. So depending on where you are, if you're listening to this, your state may have its own estate tax, transfer tax, but focus on the federal today. So the federal system is predicated on the size of your estate. So the federal estate tax exemption that we're always talking about is basically the number at which your estate becomes taxable. So for 2025, the magic number is $13,999,000, and that's for each individual person. So one person, 13.99 million, married couple, just under 28 million. So those are the numbers we'll be working with. I'll probably use 14 and 28 because it's an awful lot easier than the 3.99. So what we have to deal with is that under the current law that was actually drafted by this president and his administration the first time he was in office, this exemption amount is expected to sunset at the end of this year, which is a very fancy term for it's going away. And it will revert to where it was 10 years ago, which was about $5 million, and then it'll be inflation adjusted. And the good news about the little inflationary run we've gone through is that they're anticipating that number will go to around $7 million. So if nothing happens, and we can talk a lot longer than this podcast about whether the administration will be able to get anything done on the estate tax law side. But if nothing happens, 2025, $14 million, 2026, $7 million. And the way that the estate exemption is crafted, it's basically a use it or lose it. So if you don't die this year and you don't do planning this year that absorbs all of your exemption amount, as of next year, you'll have roughly half the amount that you can pass estate tax-free.
Well, that's a significant number. Literally, it's cut in half. I'm glad you chose to use 14 million. Easy math for us, taught too, and people listening to understand 14 million. So, with 14 million, you've got 7 you could use this year and keep 7, right? What you said, nothing happens by operation of just time. We don't need legislative approval for this to be reduced. It's going to happen January 1 of 2026. So I've heard a concept of portability. Could you walk me through what that means today? Because I think that's important in planning as well.
It is entirely, and it's extremely important. So it basically is the ability for spouses to move unused exemption back and forth between each other. So you roll back a number of years to when you and I started in this business. A married couple each had their own estate tax exemption amount, but if one of them died without using all of it, it expired. And the surviving spouse was unable to use it. Fortunately, they crafted a provision in the tax law that says married couple, if the first spouse dies and doesn't use their entire amount, again, this year, $14 million, then that amount can elected to be rolled over to the surviving spouse and they will be able to utilize it into the future. So it's a very important tool. We're anticipating that will stay in the modified law, so that $28 million per couple, no matter who dies first, and then in 2026 it'll be $14 million per couple, no matter who dies first.
All right. Well, thank you for letting us hear about portability. I know a lot of people discuss, and I think some people misunderstand what that means. So it seems like to be significant planning opportunity, particularly what's coming down the pipe with exemptions. So to follow up a little bit on our news feed, what is the current administration telegraphing, if you will, or what kind of information, communications? I know it's all over the board, what you're hearing might happen, but could you kind of quantify an extension? I've heard some things about the SALT reform concurrently going on with some exemption reform. What are you hearing out there from your sources?
I've heard everything from full 10-year extension of the existing law that was created under the TCJA. I've heard SALT reform. I've heard everything to complete repeal of the entire income, gift, and estate tax regiment, and that they'd institute what would basically be a national sales tax or something like a value add tax. So as of right now, I don't see anything leading the way as a high probability candidate for what could replace this law. And the legislative risk associated with waiting on that is pretty significant. So, they're going through so many other things right now with Ukraine and Doge and all these other things. I don't really even see, tax law changes popping up very often in this arena. So, any number of things could happen. The only thing we know for certain is that if they do nothing or are unable to do something in the affirmative, this law will sunset, the exemption will go away. So that's the thing we're really resting on is, this one's already set. And so it's going to happen unless they can come in and do something. And if it looks like they're getting closer, and if it looks like, that might happen, we can reformulate and rediscuss this.
Sure.
The other thing is that there's a lot of reasons why it could be advantageous for somebody to take advantage of this, even if it doesn't sunset. So, having $7 million to pass tax-free is a real significant advantage. And, one might say, well, if I did that now and wake up in 2026 and I didn't have to do it, then I shouldn't have done it, or I lost something. And there's an awful lot in the estate tax calculation that could still make that valuable. So once you get it out of your estate, all the appreciation on those assets after they're transferred out is also outside of your estate. So, let's just take a hypothetical. Nobody's made lifetime transfers. One spouse transfers out $14 million this year into a vehicle that could potentially provide them access to those funds should they really desperately need them in the future. But the advantage is, depending on their age, they transfer out $14 million now. 10 years from now, it's worth $28, $30 million. That's still outside of the estate, and all that excess growth is outside of the estate. So, there's a lot of hand wringing around what's going to exactly happen with this exemption. But that's one of the reasons why we're really just encouraging people to, find a qualified professional, like Centura if you need one, and start having this discussion now about what it might look like.
Yeah, real quick, let's just touch on a little bit about the legislative process. Is the juice worth the squeeze to change this or not? Because, this is one of the things right now that politically doesn't have to be voted on, right? It's an operation of law. I think they expire 10 years from when they were set, which is where we are today. But talk a little bit about the legislative process from your background. How hard would it be to change this? I think the margins are pretty narrow in the voting process.
The biggest problem with everything that's going on, in my opinion, this is my opinion, strictly not Centura's or anybody else's, is that they're trying to do so many things at the same time. And as you know, and a lot of people on watching this or listening to this will know, federal legislation has to be revenue neutral to the government over a 10-year time frame. So with all of the cuts that they're trying to make from government programs, from all of the other cuts they're going to be trying to make from changing the income tax structure and funding for all the various programs that they're trying to realign, the ability to add this in and add in the amount of money it would cost to project this. Now, comparatively to the other things they're tackling, this isn't actually as expensive as a lot of the other things we just mentioned, but it is expensive. So in a world where you have to create a system of revenue neutrality, which is what they had to do 10 years ago when they passed this thing, if this was the only thing on the legislative agenda, I think there'd be a real strong possibility that they'd get it through and it wouldn't be a problem. But the numbers that are going around about everything else they're trying to carve out of the federal budget, again, could it happen? Absolutely. Never say never. I'd never, try to really predict all that stuff. But if you're really just hedging your bets or, eliminating as much risk as you can, operating under the presumption that it's going to go away is probably the safest bet, even though we just still don't know.
No, I really appreciate your comments there. I know a lot of our clients that we work with are looking out 5 and 6 legislative periods down the road, right? So you have presidential change, you have senator change, congressional change. So we're really looking at that legislative risk. We have something we can use today, 14 versus 7, right? And if the difference is 40% tax, right, on a transfer, so we can move out an additional $7 million this year. And save 40% tax on that. Well, let me ask you this. A lot of clients are probably, hey, I'm going to wait and see. I'll wait to the last minute, and I'm going to get that done. Could you walk me through, kind of the risk of wait and see and what parties are involved? Because it's not as simple, I think, as I just transfer money into another bank account, right? If I want to make a transfer.
I mean, it could be. The problem is, the famous example or answer to everything in this situation is it depends. And the answer to your question is it really depends. So if you're going to write a $14 million check to one of your kids or to one of your grandkids, it could be that simple. Most people are not going to want to do that. So if you're looking to set up a trust and set up a spousal lifetime access trust or a slant, which is a non-grantor version of a SLAT, so that in the future you could potentially have access to the funds should your situation change and you need access to these funds, you're going to need an attorney to draft that. And they're already, behind and underwater with the amount of these that they're doing right now. If you wait until the second half of the year, if you wait till the fourth quarter of 2025, if you got an attorney on speed dial and they'll draft whatever you want in whatever time frame you need, you're good. Most people that I know, even with the best attorneys out there, are not in that situation. So, setting up the trust, if you're going to transfer non-liquid assets, if you're going to transfer a business or some private equity or some real estate, you're going to need to get those things valued. The valuation people are all getting more and more busy. So everybody that we're talking to on the professional side, it's start now, or the chance you run is you might literally not have somebody with the availability to do these things before you're in.
Yeah, I think that's some pretty wise comments and wise insight there, in that go ahead and set some structures up now, and then you can move when you need to move. But I agree with you, at year end, getting appraisals and just year end in general is busy for a lot of people. Let's kind of talk about different tiers of net worth and how those different tiers might use the exemption. And I'm going to break it down into 3 tiers. We'll just take one tier at a time. But let's talk about people right now that have 20 million or less of net worth. How would you see the exemption playing out between now and January 2026 for them?
So those are the ones that are the toughest. So, you're under $14 million, you have no issue because you'll be a fully exempt estate in the new legislation. Somewhere between that and, the numbers you're talking about is where it starts to get tricky. So north of 40, north of 50, this becomes more of a layup. You can, transfer half of your estate into a trust that you may or may not have access to if you need it, and have the rest of your estate to live off of. But I think, what you're talking about is kind of that. The one that I always use as an example is, let's say you're worth $28 million. So you could right now transfer out your entire net worth and never have to worry about paying estate tax on it. The question always becomes, what the heck am I going to live off of?
Right.
So, and this again gets back into every situation is different. If this is a 90-year-old couple we're talking about with $28 million, their time frame is going to be a little bit different. I don't think they're going to see 4 or 5 administrations to come. So the way they look at that question might be a little bit different. You got a 35-year-old couple who's worth $28 million. They're going to see those administrations. They have the time to wait for that. They have a lot longer that they need to live off of assets. And they may end up consuming them, which is also an estate tax strategy, although not one many pursue. So one of the things that we recommend in that situation is looking at the idea of having one spouse use their full exemption amount and the other waiting to see what happens into the future. So what would happen in that hypothetical is $28 million, you'd transfer $14 million of it out into a trust structure. Some of them are accessible, the slat structure we talked about. Now that does, really hinge on the fact that you plan on staying married. So again, depending on who you are, where you are in your life cycle, the probability of that is something for you to examine on your own. But from a tax side, you use one exemption now, you roll it into the future. So in 2026, you're not losing quote unquote $14 million. It's only 7. And then it's the same situation. You're moving out half of your estate, you're leaving half of it to live off of and potentially consume. So it's an interesting way to tackle that problem. But again, it's going to be really highly specific to each individual or each couple, and they really need to sit down with somebody who can model these numbers and walk them through what the alternatives are.
Yeah, and I'm glad you brought that up. It's just not as simple as my net worth is X, and I'm going to subtract Y, the exemption, I'm going to do the planning. We spend a lot of time as Centura analyzing the client's balance sheet, their cash flow statements over a period of time to make sure they have the cash flow and the assets in their estate they need to live off of, and additional things for charitable or legacy planning. So I'm glad you brought that up. So let's, we kind of talked about the 28 million below. Let's do 35 and above. If our client comes, as 35 million or above net worth, which we work with, how does that change your perspective? And obviously it's case specific, but generally you might have some different thoughts on how they might use those exemptions today.
Again, it depends so much on the clients. That 80-year-old couple, that 90-year-old couple, they're probably going to want to transfer the full amount away because of the ability to do that, to save their family that much money in estate taxes, and to with them having such a shorter time frame that they'll need assets. And I go back to that 35-year-old couple. 35-year-old couple with $35 or $40 million may still not want to transfer away 28. They have a really long way to go, and they may not be worried about that at all. And in between there's so many different ways you can look at that. A lot of it depends on what your opinion is of the estate tax system. I worked early on in my career with a military vet, and I presented him this elaborate estate tax analysis on, I think at the time he was worth $45 million. And he just smiled at me and said, the government can have as much of my money as they want. I don't care. Don't hear that a lot, but again, it just depends on how you feel about taxes, how you feel about charity. For a lot of people, this isn't an issue as long as you're willing to give everything above the estate tax exemption away to charity. So you're worth $30 million. You can give away 28 million combined this year. Next year it's 14. But if you're happy with your family getting $14 million and the rest of that going to charity, you don't have an estate tax problem. So it just goes back to what we've been talking about is everybody's got to sit down with a qualified professional, go through their personal situation, go through their wish list of who they want to have receive their estate, how much of it they want them to get, and then what the options are with that.
Yeah, no, I appreciate your insights there. So what should our listeners do? They're somewhere in the, range of 20 million to above 50 million. We kind of talked on about there is a sense of urgency, I believe, between now and year end to get structures and appraisal set up. Obviously, clients that we deal with and you work with on a daily basis obviously have more than one business entity a lot of times or different structures. We have to coordinate the movement. So what are your thoughts on what should our listeners do today?
If they're worried about it, if they want to see what it looks like, if they're not willing to roll the dice, they need to find somebody to sit down and talk to. And we're really good for that and always available. So hopefully people can reach out to us. I know our contact information will be available at the end of this podcast, but it's really sitting down, drawing out all the numbers, having the discussion about what you'd want for your estate and for your legacy, and then going through the options. So it's infinitely simple and infinitely complicated depending on what you're trying to achieve.
Yeah. And I would say, would a lot of our listeners may just say, hey, I'm going to call my attorney, but maybe you could expand a bit about, the expanded team that we offer at Centura, where we quarterback between all your advisors. And I think that's super important as we look at how you use an exemption, because once you use an exemption, it's gone. So we want to use it correctly and file the appropriate paperwork, as based on entities and how we're gifting that, if you will, or transferring that number. So if you could talk a little bit about that, I think that'd be helpful for our listeners.
Again, it's going to depend on your attorney. If you have a really good estate planning attorney, and we work with some of the best in the business, they're going to do a lot of the modeling and a lot of the analysis, a lot of the discussion that we're doing. A lot of people work with business attorneys and have them draft their wills, and they're not as versed in this kind of thing. If you're working with somebody who's, got a really solid handle on high-end estate tax planning, you can talk to them too. I mean, looping us in on the discussion is always helpful, just because of the nature of what we do. And to your point, being able to discuss across different professions with appraisers and CPAs. And, part of this is collecting historical information on what you've put away in the past, because that affects your exemption. So if you've got somebody that you like and is competent to excellent, reach out to them. Reach out to somebody, I think, is the important part.
My big takeaway, Daniel, from your insight today is, and I don't mean any puns intended, but what a gift, right? We have 14 million, 28 million per couple this year to use. And if it goes away, it goes to half in next year, 14. So we actually have a really nice planning opportunity that people should pay attention to, think through. How can I best maximize that? And what can I do to get out ahead of the curve at year end to avoid the rush, if you will, right? Any final closing comments, Danny, you like to add? But what a wonderful opportunity our clients and listeners have this year with extended exemption numbers.
It really is. I mean, just anecdotally, when I started in this business, the federal estate tax exemption was $600,000. So, the ability to transfer $28 million to your family and not have anybody pay estate tax on it at a federal level is darn remarkable. So in the right situation for the right people, they should be pursuing that, taking advantage of it before the window closes. But, as we've said many, many times, it depends on the situation, on the individuals, on the circumstances. So sooner they can get a hold of somebody, sit down and start talking to somebody, the sooner they can have a plan. And if they need to, start implementing on it.
Daniel, I'd like to say thank you for your time today. Your insights were wonderful. I learned a lot of things for our clients to think about. Let's evaluate that exemption. Let's look at our current balance sheet and planning, and let's put something in place so we're ready to go at the end of the year. But again, thank you, Daniel, for your insights. Learned a lot, and I hope our podcast listeners today found this insightful and valuable for legacy planning, charitable planning, or just planning for your family in general.
Thank you, gentlemen. And most importantly, thank you for listening to the Live Life Liberated podcast with the team from Centura Wealth Advisory. If you have not subscribed to the podcast, please click the subscribe button below. This way, when the team comes out with a new podcast, it will show up directly on your listening device. And we humbly ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thank you for listening. And for everyone at Centura Wealth Advisory, I'm RJ Malik, reminding you to live your best day every day, and we'll see you next time.
Thank you for listening to the Live Life Liberated podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Centura Wealth Advisory. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Centura Wealth Advisory, Centura, is an SEC-registered investment advisor with its principal place of business in San Diego, California. Centura and its representatives are in compliance with the current registration and notice filing requirements imposed on SEC-registered investment advisors, in which Centura maintains clients. Centura may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Past performance is no guarantee of future results. Tax relief varies based on client circumstances, and all clients do not achieve the same results.